Hello, welcome to Crypto Insights, where we teach you about crypto. My name is Thomas, and I'm the host of this channel. This video is for absolute beginners in DeFi, so decentralized finance. After watching this full video, you will know the difference between DeFi, CeFi, and the current banking system. You will have a basic understanding of what are stablecoins and what are the benefits of stablecoins. You will understand how borrowing and lending will work in DeFi, how insurances will work in DeFi, and what are decentralized exchanges. So with all of that said, let's jump into this week's video. So let's start off with the differences between the current banking system, CeFi and DeFi. CeFi and DeFi are mainly focused on cryptocurrencies, while the current banking system is focused on fiat currencies like euro and dollar. So currently, the banks are responsible for all the transactions and the distribution of wealth. If you want to borrow money out to the bank, you will get an interest rate. We call that saving. If you want to borrow money from the bank, you will have to pay an interest rate, which is many times higher than the received interest rate. The cut is for the bank. So the bank makes profit on lending out your money. If we then go to CeFi, you can lend out your cryptocurrencies to other people through a company like Celsius, Binance, or Coinbase. They're responsible for that transaction. They take a much smaller cut than the banks do, but still take a cut. So therefore, there is DeFi, which is decentralized finance, which means that you're depositing your money in a smart contract, and the smart contract will lend it out. And that is the smallest cut there is. So that is the difference between the current banking system, which is only dealing with fiat, euros and dollars, centralized finance, which is focused on cryptocurrencies but still has a middleman, and decentralized finance, which is basically a smart contract and doesn't have a middleman anymore. So in order to understand the decentralized finance, you need to understand stablecoins. So the current stablecoins are all dollars. So you have the Celo dollar, you have the Binance dollar, you have the USDT, you have the USDC, and they're all pegged by the dollar. There is multiple different stablecoins and different mechanisms, but I just want to explain the basis in this video. So a stablecoin is always backed by $1, meaning at some point somebody paid $1 for a stablecoin that represents that dollar, and another person that receives that stablecoin can always exchange it back for that dollar. So a stablecoin that is backed by the dollar should always be exchangeable by the dollar. So therefore it is stable, because one stable dollar is always the same as a dollar. While with cryptocurrencies like Bitcoin and Ethereum, they go up and down in price. So how does this lending and borrowing then really works? Because you always have to deal with collateral, right? So the borrower always has to over-collateralize the borrowing. So if I want to borrow $100 worth of stablecoin, I would have to put in a cryptocurrency that's at least $100. Then you would ask yourself, so why would somebody lend cryptocurrencies that they already have? So if you have a Ethereum or Bitcoin and you really trust that the value of Bitcoin and Ethereum will go up, you can use that as your collateral. In that way, you can play and earn money with the borrowed money, and your cryptocurrency that you put in as collateral can also go up in price. So I could lend $100 worth of stablecoin and my collateral would be Bitcoin. With that $100 of stablecoin, I put it in Binance for an 8% return. So this way I get 8% on top of the stablecoin, and I can get a profit based on the price going up of Bitcoin. So I have a win-win on both sides. So that's why people borrow. Of course, Bitcoin can also go down in price and you will have to pay off your loan. So there is definitely a risk involved. You can also see this with people that already paid off their house. Like if you already paid off your house, you can use that as collateral to get more money, because you expecting your house to go up in value and you want to just pay back your loan. Or maybe you have a business idea that you're also expecting to win. So in this case, you can profit from the increase of the house and also the return on your business. So this way also works in crypto. So what is a decentralized exchange? So decentralized exchanges are the core of DeFi. So decentralized exchanges are not regulated and are not centrally stored. The decentralized exchanges are managed by all the people that are owning that token. So by owning the token of a decentralized exchange, you have voting power in the system. So that's why decentralized exchanges are not limited to any country. The centralized exchanges have to commit to the regulation. This means that all the currencies that they're providing that you can trade on their platform had a security check, and therefore they're more safe to trade. But in DeFi, it's really when the earliest coins are released. So there is also a possibility to get insurance in DeFi, and this is really an upcoming sector because besides the fact that you want to have physical insurance, now you can also insure yourself against some DeFi protocols. So how does this insurance work? It's literally a smart contract that says if your car breaks down, you get this amount of money. That's what the smart contract says. But in order to check if your car broke down, you need an oracle like Chainlink. That is something that is linked to the blockchain, but also to the physical world. So Chainlink can pick up, yes, your car broke down and it's been verified by the garage and by the authorities. Now the smart contract should pay you out the insurance. So that is how insurances would live in the decentralized world. So now you know the basics of DeFi. You know the differences between the current banking system, CeFi and DeFi. You know the basics of a stablecoin. You know how lending and borrowing works in DeFi and how the loans are over collateralized and therefore decreasing the risk. You know how a DEX work, a decentralized exchange. You know the benefits and the negatives, the pros and the cons. You also know how insurances work in DeFi and what is an oracle. So this is the end of the video. If you liked it, please like and subscribe so you don't miss out on my newest video. If you have any ideas for content that I could provide you, let me know in the comments, and I hope to see you next week. Bye!